So fair value measurement, IFRS 13. Fair value measurement defines fair value. Okay, that's a standard which defines fair value, and it also sets out the framework for measuring fair value for assets and liabilities, and also an entity's own equity instruments. This standard is applicable to all IFRSs except the following. You need to know those standards which are exempt from IFRS 13. Questions have come where they apply the standard to another standard which is exempt, and students have gone ahead and done all the computations instead of simply stating that it does not apply. So those which are exempt are IFRS 2, share-based payment transactions, IFRS 16, leasing transactions, and then measurements which are similar.
So you said IFRS 2, then?
IFRS 2, share-based payment transaction. IFRS 16, leasing. And then those measurements which are similar to fair value but not the same. These are IAS 2, net realizable value of inventory.
Those measurements which are similar to fair value?
Which are similar to fair value but not the same. There are two of them. Net realizable value, IAS 2. Then from IAS 36, value in use.
IAS 2 net realizable value.
IAS 2 net realizable value of inventory. So these ones are exempt from IFRS 13. So what is this fair value? Fair value is a price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. What does that mean? It means it's a price which you would sell a product to someone whom you are not connected, you are not related, you've got no relationship. Okay, at a particular date. The fair value measurement is based on an asset or a liabilities unit of account. Simply meaning individual assets or liabilities.
So fair value measurement is related to the unit?
It is based on an asset or a liabilities unit of account. And for most assets and liabilities, the unit account is the individual assets or liability. Although in some instances there may be a group of assets or liabilities. Go to measurement. The fair value is a market-based measure, not an entity-specific one. So it doesn't depend on an entity. It depends on the market. So it uses, it tries as much as possible maximize the use of relevant observable inputs and to minimize the use of unobservable inputs. So, to increase consistency, the fair value, it establishes a fair value hierarchy, which is divided into 3 categories. So the first one is level 1 inputs, which are quoted prices. These are prices in an active market for identical assets and liabilities.
So these are prices in?
These are quoted prices in an active market for identical assets or liabilities. An active market is a market in which similar assets are traded on a regular basis. Then level 2 inputs are inputs other than quoted prices. These are inputs other than quoted prices included within level 1 that are observable for the asset or liability, either directly, i.e. through prices, or indirectly, i.e. derived from prices.
Sorry, come again. These are inputs other than quoted prices.
These are inputs other than quoted prices included within level 1 that are observable for the asset or liability. Okay. Observable either directly through prices or indirectly derived from prices. Here we're talking of quoted prices for similar assets in an active market. Okay. So your asset is not quoted. You're comfortable with quoted, right? When you say quoted, you're comfortable with quoted. Quoted, let's say when a share is quoted, it means this share is listed on the stock exchange. So if you're measuring a shares for a company which is not listed, so you're going to equate that to a similar company which is listed on the stock exchange. Clear? Or for identical or similar assets in non-active markets. Level 3 inputs, these are unobservable inputs for the asset or liability. These ones we use discounting. So you discount the cash flows from that asset.
So these are unobservable inputs.
Unobservable inputs for that asset or liability. The level 3 inputs, these are used only where relevant observable inputs are not available. That's when you use level 3 inputs. Or in a situation where the entity determines that the transaction price or quoted price does not represent fair value. Now, in using fair value measurement, it is assumed that the transaction takes place in the principal market. The principal market is the market in which the highest volumes for that asset or liability are being traded. Not the highest price, but the highest volumes. In the absence of a principal market, then we use the most advantageous market. And the most advantageous market is assessed after taking into account transaction costs and transport costs to the market.
So in using the most advantageous market?
Okay. To come up with the most advantageous market, you take into account transaction costs and transport costs. But once you have determined the most advantageous market, to get the fair value, we only take into account transport costs. We exclude transaction costs. The fair value should be measured using the assumptions that market participants would use. Okay? In simple terms, market participants would act in their best economic interest. So those are the assumptions that you make. So if you look at this illustration, you've got two active markets, one in Europe, one in North America. In Europe, the selling price for the same commodity, the same product is 53. In North America, it is 54. Transport costs in both markets are given there, which you add, then you are given transaction costs, which you subtract. So you have a higher profit in the European market, a lower profit in the North American market. But because the North American market is selling more, that is the principal market. Clear? So, based on the principal market, the fair value will be $48 per item. When determining the fair value, we do not include transaction costs. Remember in IS2, inventory. Inventory, how do you value inventory? It's costs plus transport costs. If you're going to transport that inventory to its intended location, you include transport cost in the inventory. Okay, so same principle here. Now, if there was no principal market, how would we determine the most advantageous market? The most advantageous market is the market where you're making the highest profit, which in this case is the European market. So, to determine the fair value now in the most advantageous market, to be 50 minus the 3, the transport cost, to give us, 53 minus 3, to give us 50 as the fair value in the most advantageous market. Clear? We now look at areas where questions may come from in the exam. The first one we look at is non-financial assets. The fair value measurement for a non-financial asset uses where the asset is in its highest and best use. We look at the use that would maximize the value of that asset, either by selling it to another market participant, okay, but in looking at the highest and best use, we take into account the use that is physically possible, legally permissible, and financially feasible. Meaning there should be no legal hindrances to use this asset.
So when looking at the highest value, you look at
So would the value be maximized by using this asset, or would the value be maximized by selling it to another market participant? The highest and best use takes into account the use that is physically possible, legally permissible, and financially feasible.